right. Hello, Finimizers, and welcome to another modern investor event by Finimize. My name is Reda, head of research here at Finimize, and I am absolutely delighted to host today's session, Unlocking Private Markets Access, brought to you in partnership with Powerlaw as part of our Modern Investor Community series. Now, before we get started, just a few very quick housekeeping rules. First of all, please feel free to introduce yourself in the chat, react to any comments that are being made, and look out for polls throughout the event. Second of all, today, just in terms of format, is a fireside discussion with our guest, followed by audience Q&A, which takes me to my third and final point. Please use the Q&A box to submit your questions. This is your chance to ask our host, the expert, and you can submit anonymously if you want or not. It's completely up to you. Now, today's session, like I said, is brought to you in partnership with Powerlaw Corp, NASDAQ ticker PWRL, and basically it's a registered closed-ended investment company designed to give investors exposure to later stage private technology companies through a public listed structure, which is very convenient. Now, of course, no finance event is complete without a disclaimer. So just, quick things, your capital is at risk. This is not financial advice, what we are going to discuss here today. And your tax treatment depends on your own individual circumstances and may be subject to change. Now, with that out of the way, it is my genuine pleasure to introduce our guest today, Ben Black, founder and chief investment officer of Powerlaw Corp, and a 20-year private equity veteran. Ben is also co-founder of Akkadian Ventures and the Raise Global Summit, which has grown into a premier launchpad for emerging venture capital funds. Ben, it's fantastic to have you here with us. How are you doing today?
So great to be here, Reda. Thank you so much for having me. I really appreciate it. Excited to talk
And
to everyone.
absolutely, and I'm really excited to talk about what we're going to talk about today because it's something super topical, I should say, and
Yeah.
something really really exciting. Now, before we dive in, just for everyone, you'll see a poll on your screen. Please take a quick look and cast your vote. Let's try to make this a little bit interactive. And with that out of the way, let's kind of get in. And Ben, before we kind of get into the mechanics, of the fund and discuss
Yeah.
everything, I just want to kind of take a step back and just ask you a little strange question, which is why are we here? Why are we having this
Yeah.
conversation right now? Why are we talking about private markets access today? What has changed essentially?
Well, I mean, what's changed fundamentally is that it's just taking so long for companies to go public. And, the entire venture capital system has kind of evolved in this way that where so much of the capital goes into very late stage businesses. And because there's a very active secondary market, there is no incentive for the best of the best companies to go public until they're so huge that really most of the value has gone and been realized in the private markets. So, I think that we're at this point where 5 years after COVID, and everyone's been seeing every year, oh, the IPO market's going to come back, you know, this year. There was only 17, tech IPOs last year, right? And so the lack of IPOs and the fact that all the best companies are just opting to stay private means let's talk about another solution.
Really interesting. I want to kind of unpack that a little bit. So you said,
Yeah,
companies are staying private longer, which is, definitely true, and going public at much higher valuations. I mean,
right.
just look at SpaceX, right? I mean, that's the perfect example.
Yeah.
And that's if they're going public at all, right? And I want to get your perspective on this. Like, what does this mean for the everyday investor who's only ever really held publicly listed
Yeah.
stocks?
Well, so the everyday investor knows that the money, the money's been made in the private markets, and they need to figure out a way to get exposure. There are a bunch of ways that an investor can get exposure to the private markets. Yeah, you can try to go invest in the private markets directly through a VC fund, uh, but then your money's locked up. There are very high minimums, not very. They have accreditation requirements. So that's not really an option, right? Um, You can try to go buy, secondary shares through companies like Forge or Equity Zen. Um, Again, you have no information. You don't know. These are highly sophisticated counterparties. The everyday investor is going to have a hard time doing that. You can invest in, and so what we did with Powerlaw is we said, look, let's make this as simple as humanly possible, right? We said like by 1940 Act closed end fund, registered by registered with the SEC, with transparency and daily liquidity, and let's go create, instead of having the everyday investors have to go navigate the craziness of the private markets. We've been doing this a long time. We'll do that for them, and all they have to do is buy the portfolio.
Really fascinating. And I want to kind of touch on some of the things you said there,
Hmm.
specifically around accreditation rules,
Yeah,
high minimums, which have historically, kept most people out of this asset class for decades,
yeah.
right? And in your view, is that actually protecting investors, or is it mostly been kind of gatekeeping?
I think the reality is that all of those rules were meant with the best of intentions at the time, right? It is, I mean, the accreditation numbers, I don't know when they were created. They've been around as long as I've been in venture, so more than 20 years, right? And I'm sure that the SEC and Congress meant well, right? There was people out there doing shady things, right? But you know, ultimately, when you sit there and you look at the fact that all these companies are staying private so long, and the retail investors, let me put it this way: how is it protecting a retail investor to say you can't invest when SpaceX is worth 200 billion, but the day it goes public at extraordinarily high price, it went up 10x in 2 years with all the new debt that it had, and at that moment suddenly it's safe. I think the much safer deal was getting in at 200, right? So the rules are well-meaning. They're well-meaning, right? But at the end of the day, like, it just keeps people from being able to get exposure during the time that the value is created.
No, it makes perfect sense. I love the SpaceX analogy.
Right.
Um, and okay, so then looking at kind of different ways people can start to access these kind
Yeah.
of private markets, etc. We're seeing interval funds, we've got
Hmm.
BDCs, tender offer platforms, etc., etc. But like in plain English, what's the difference between owning a piece of a private company directly versus owning one of
Yeah.
these esoteric vehicles, if you will?
Well, every different structure that you can use to create private market exposure has its pros and it has its cons. All right. And so I'm going to state it really kind of sort of simple and straightforward. You can try to go invest in individual private companies through the various platforms that are out there. Plus, there's all sorts of people who raise single purpose vehicles, and your money's going to be locked up. You're going to be completely at the whim. There's no governance. There's no transparency. There's no information, and you basically are just hoping that the manager you work with actually does what they're supposed to do. And it's then there's a lot of good people in that business, and there's a lot of bad people, and that's dangerous, right? Interval funds are kind of like the mix of both worlds. You can create portfolios of private companies, but and you can get them at net asset value. In other words, that the fund is designed to always have the price of the fund be equal to the price of the underlying assets. The problem with interval funds is that in order to make that work, you don't have real liquidity. So at best, you can get 5% of your capital back a quarter, which means you have a 5 year time horizon to get your money out, which most people can't do, right? So it's like it's a semi-liquid structure. So great that you get everyone's at now. Everybody's the investments are all at now, but rough on the redemption side. The third way is a publicly traded closed-end fund, and obviously I'm talking my own book here, but I want to make it clear, like, when you have a closed-end fund, The shares trade daily on an exchange. The underlying assets stay sort of solid. They sort of just sit there. Now, the benefit of a closed-end fund is you can have daily liquidity. Like you can go and just sell your shares. I'm not saying you could sell it all at once, or there might not be market, issues at the particular time you want to sell. But the idea is that the shares trade every day. Now, uh, in order to make that work, you can't have the price of the fund and the price of the assets be mechanically locked because we closed-end funds, you can't redeem shares and create and destroy shares. So the downside of the closed-end funds is you have to look and have some judgment about where the market capitalization of the fund is trading relative to the net asset value, how much all these things are worth. So just using hypotheticals, if you got $1 billion of assets and the fund's trading its market capitalization is 500 million, that means it's trading below NAV. You're getting a discount. But if it's trading at 2 billion, that means you're paying effectively twice as much for the underlying assets. So, in this case, buyers need to go in and take a look at the portfolio, how it's valued, how it's trading. But the benefit is you can choose your own adventure. Once you're in, you can keep it in your brokerage account. You can go do whatever you want. You can margin loan against these things, but you have to pay attention to how they're trading.
Really, really well explained. Thank you so much, Ben. And just on that liquidity front, so what happens, let's say, worst case scenario, in one of these kind of different funds and everyone wants out at the same time? What happens in that case?
Well, what would happen if all of SpaceX shares were suddenly tradable tomorrow, right? If everyone wants out of any public company, and the price is going to go down, right? So it's a sort of run on the bank. What's interesting, so if everyone wants out, then I would expect that there's going to be price pressure. Now, that has no impact on the underlying portfolio, right? And so then it becomes a screaming buy, right, for somebody who's more value oriented. Because as we well know, the public markets routinely swing, especially when we look at individual companies. Like, if I looked at any company, out there in the software world, it's probably gone up and down 50% in the last year, right? And that's going to be the same for any of these vehicles. But again, you just got to go back to the fact that there are real assets inside them, and that should provide some sense of base value. One would hope, although it could go, the prices can fall. It's the stock market.
As Ben Graham said, Mr. Market is very moody.
Yeah, very moody, and the thing is you got to stay in it, and hope for the good days, and hopefully the good days outweigh the bad ones. We've certainly had some wild times so far this year,
To say the least. Um, and then I want to ask something in terms of, when people kind of invest in private markets, etc., through these different vehicles, what's the honest timeline someone should expect their money to be tied up? And why doesn't access necessarily guarantee returns? Just because you're in a vehicle, that doesn't necessarily, guarantee returns, essentially.
So for talking about investing directly in the private markets, I think that's your question. The time, this, like, I've been doing this for 16 years, right? And every year I get a question like, when is so and so company gonna get sold or be liquid? Well, the CEO doesn't even know, right? Like, because there's so much uncertainty about, you can't predict when a company's gonna get bought, and for IPOs, there's a whole host of things that go into deciding, is the market open? Is it risk on? What other IPOs are out there? So like right now, you have SpaceX, OpenAI, and Anthropic. SpaceX has gone, two other ones pending, and they're just kind of crowding out everybody else, right? Right. So your duration, I guess whatever you were told by whoever got you in a particular deal, VC deal. If he had told you we'll be an IPO in 3 years, an IPO 2 years, I would double it for real. You know what I mean? Because the bar to get uh, bar to get public just keeps getting higher and higher, and that means the company's got to get bigger and bigger, and the companies don't want to go out, and then they stay private and they can raise all the money they want in the private market. So the water's warm in the private markets, and it's kind of cold out there. So you got to have like a pretty long duration viewpoint, and that's okay, because that can work. But the VC business is all about patience.
I like that. I feel like the entire investing game is all about patience, but
Yeah,
probably more
absolutely.
important in the VC game,
VC.
if anything.
Yeah.
Um, and then, sticking to kind of these products as a way to kind of gain exposure to private markets. And if someone, let's say a retail investor, is evaluating one of these products for the very first time, what are the top two or three things, in your opinion, they should actually check before putting money in?
Yeah. So I would look at the team. Is the team that's doing this actually venture capitalists? Have they run portfolios in good times or bad? Um, Very important to look at the whole portfolio. I think that one of the big sort of challenges of the space has been there's been just one or two logos that everyone's excited about. And if you think about the fact that those logos, are maybe 20% of a portfolio, that means 80% of the portfolio is in other things. And you have to take the time to go through the portfolio and ask yourself the question like, do I believe that this business has real upside over the next 5 years? Um, and that is, I think, really, really important. Obviously, you got to look at structure and fees. Of course, are always a factor to consider. But it's really, and obviously, you want to be, investing where there's not a lot of cash. It doesn't make a lot of sense to invest if there's a lot of cash on the balance sheet because they've got to go deploy that cash. So you want to look into the details of it, but really focus on every single company in the portfolio before you buy one. And because, just buying a logo doesn't make any sense.
Very well said. And maybe penultimate question. So, where does all of this kind of go from here? Like, as in, what's the direction of the industry? More retail friendly access or a pullback
Yeah.
potentially? And if you were advising someone starting a portfolio today, how would you tell them to think about private markets?
Yeah. So I think the biggest question that's happening, in the next couple of years is, we got to get beyond OpenAI and Anthropic, right next. So they're the next big sort of story that's overhanging. And I will tell you, there's an incredible array, in my opinion, of really exciting companies out there that are not, as well thought known by the public, but that they will be soon. I mean, just to name a few from our portfolio, Vast Data is one. They do the software where basically it's data storage software, so that if you're using the LLMs, it connects the data to the GPUs. And this software is in everywhere. They have a huge market share, and every time you use, a lot of times if you're using OpenAI or Anthropic, like Vast Data is powering the whole process in some sense. Now, that is a company that nobody knows about. It's growing like a weed. It's absolutely amazing business, in my opinion. And that is an example of a company that will be famous next year, but we haven't heard of it yet, right? So, I think that like anyone looking, the story's kind of been told with OpenAI and Anthropic. Like it is what it is, and it's really looking at that next generation of great businesses and the applied intuitions of the world. Just to name one off the top of my head that we're not in. Um, you know, these companies are ends of ones. They're really exciting. They're not, you know, as crazy in their growth as Anthropic is, but they're going to be around for a long time, and they're much better prices. So, so I think that's what everyone really needs to be asking themselves is what's next.
And speaking of what's next, takes me to my final question, which is, what advice would you give people to people who feel like they're always late to these
Yeah,
opportunities? Do you know what I mean? So they've seen OpenAI, Anthropic, etc.
yeah,
They've missed out on them. They're asking
yeah,
what's next. So what advice would you give them?
yeah. So I mean, I would say uh, the earlier, the advice I would be is like do your homework first, and really like force yourself to sit down. And there's so much information out there now about private companies. Um, and if you want to go find a way to invest directly in the private markets, it's doable. Like, the companies like Hive and other brokerages do enable you to find some of these deals. Super, if you want to really be early, yeah, you should spread your bets and have the bets be small because it's just a lot more risk in doing these. Don't put your eggs all in one basket with one SPV manager or something like that. Then, of course, like look at funds like Powerlaw. Like we're getting in to companies, at quite early stages. And I think that's a great vehicle. And I think that it'll actually as we get beyond these biggest logos, funds like ours will look to get invested at an earlier stage. Um, but then I think you want to be doing that with a professional who knows how to do boring things like portfolio construction and underwriting. So that's kind of my advice.
Amazing. Ben, thank you so much. I want to switch over now to audience Q&A. We have a lot of questions, but
Okay.
please, if you have questions for Ben, please submit them and I'll start shooting off some of them to you. So
All right.
first question over here from Mr. Anonymous. How should someone think about percentage allocation to private markets? I guess looking at overall asset allocation in a portfolio, what would you say in terms of, what percentage people should be allocating to private markets?
Well, that is a topic that it's a little bit outside of my area of expertise, right? Because I'm not running people's overall portfolios in their life. I'm focused on a very, very narrow sliver. Um, but, and it really depends on your personal tolerance for illiquidity and risk. Um, but I would say the younger that you are, I would just some general rules. The younger that you are, the more I think you should have from privates, because I think that, you know, for example, I mean, it doesn't even make sense for me to invest at 57 years old, for me to invest in a VC fund anymore because I'm not going to see the money for 15, 16 years, and I'd like to enjoy it while I'm still young enough to enjoy it. So, young people should have, I think, a much more you know, aggressive posture towards investing in the private markets, precisely because time is their friend. The other thing that's really good about investing in the private markets is that you can't be tempted by the money. So for young people who might be like tempted to buy bigger, fancier houses, putting money in the private markets, and because it's a liquid and going to be a liquid for 10 years, it keeps it away from you from doing other things. Now, for me, that is a great benefit. I've benefited by that because I don't have self control all the time. So that's a really good way to look at it. But I don't really have a good sense of percentages because it's so personal.
No, that's definitely true. There's no such thing as like a perfect asset allocation. It all
Yeah,
depends on your individual circumstances.
yeah.
I have a question from Oliver, which is basically your stock price. So PWRL seems cheap compared to the NAV. So are
Mhm.
investors basically buying the portfolio at a discount?
So I cannot speak directly about the compliance without very much upsetting my compliance people about the questions like this about the stock at all. So I'm not talking at all about Powerlaw, but it's factual to say that if any closed-end fund is trading below NAV, you're essentially it's a discount's one way to look at it, but these things go up, then they go down, and they go up again, and that's the way the world works.
It's nice to buy a dollar bill on 80 cents
Yeah,
on the
that's
dollar, I
right.
guess.
Yeah.
Another question from Dima. Does PWRL own stakes in private companies directly or via third parties charging additional fees?
So we own, we one of the sort of big parts of Akkadian. We've been doing secondaries for 16 years, so we can source direct shares. Sometimes the easiest, is, a lot of times we're going direct on the cap table. Just depends. Sometimes the easiest way to acquire shares is through a special purpose vehicle with counterparties we know and have kind of due diligence. In that case, there can be some additional fees. We tend to avoid Not in every case, but we tend to avoid carry. We are in those situations. We're always like baking off many different uh, avenues and what the total costs are. But in some of the most high profile names, it's kind of unavoidable. But it's something we manage very closely, and we're very dedicated to keeping as small as possible.
Awesome, thank you. And I'll combine two questions about SpaceX into one. So, first one is why such a high allocation to
Yeah,
SpaceX? And then the second question is, have you sold SpaceX
yeah.
now that it's public?
So why such a large allocation of SpaceX? So one, in some days, in some ways, we were subject to the success of the investment. When we bought SpaceX to the point that it went public, the value had gone up about 3.7 times. So it didn't start out quite nearly so big, but it grew in to this fairly large position. Now we're locked up just like all other SpaceX investors are until the lockup comes up, and so that means that once we go public for 6 months, or it can be, SpaceX has a staggered lockup, and it's a little unclear exactly when we're going to get unlocked. Um, but at that point, we can make a choice to either public closed-end funds can hold public stocks. It's part of the design of the fund. But at an appropriate time, we'll sell out the position most likely, and either redistribute the capital, distribute the cash, or redeploy it.
Very fascinating.
Right.
Then we have a question over here. How are you thinking about the next generation of AI companies? And I guess the million-dollar question is, are we at the beginning, middle, or end of an AI boom?
Well, that is we could have a whole day just talking about that question. In fact, my voice is kind of gone because this is exactly what I've been debating out here. I had too many conversations on this yesterday. Um, it is not uncommon when we have big technology rushes that there's a period of peak inflated expectations, and then there's disappointment, and then kind of what comes out the other end is real change. Like, you know, we've seen this with internet, we've seen this with SaaS, we've seen it, companies be overbuilt and have there be too many companies and have there be too high prices. You know, I think that I think that people who are using AI tools every day are getting tremendous value out of them. Um, Whether or not the companies are overvalued is a different question than the value of the technologies. I'm going to see a talk right after I do this on how doctors are using AI to to identify heart disease earlier and more accuracy. I mean, so there's so many powerful long-term applications that I think are so meaningful, and I'm an optimist about the impact those are going to have. That does not mean that there's not irrational exuberance in some parts of the market, right? And that can be the private markets too. Um, and that's why I think it's really important to not dabble in the sense of like just trying to pick a company here or there. We're going to have ups, we're going to have downs. But the power law says a small number of companies, that's why we call the firm Powerlaw. A small number of those companies are going to become the next big Anthropic and OpenAIs. So it's important to, if you're going to be participating, to be diversified across a fair number of companies, because it's all changing so fast, and I'm sure we're going to go through a period of dislocation that we have to come out of. But history shows, if you're patient and you're just able to ride that the ups and downs of the market, as long as the core technology becomes ubiquitous, which I think we all feel it's going to happen with AI, then you're going to be fine. In the short term, there can be ups and downs, but in the long term, I feel pretty good about it.
You know, I think that's a fantastic place to end then, because yeah, that's really well said, and I think sums up really well kind of where we are in this AI cycle and how to kind of think about it. I'm afraid everyone, that's all the time we have today. Ben, on behalf of myself, Finimize, the entire Finimize community, thank you so much. This was honestly a really, really very insightful and valuable chat. I know I learned a lot personally. And thank you everyone for tuning in. We hope to see you at the next Modern Investor podcast. Ben, once again, thank you very much.
Thank you so much for having me. It was great
Thank you,
fun.
everyone. Take
Thanks a
care.
lot.
Bye
Yeah.
bye.